Well, this is very exciting. We have made a profit of oh, hold on. We've just doubled our profit. All right, breaking news. We've just quadrupled our profit. In today's video, I'm going to show you how to trade options on Public. Now, Public is an investing brokerage that I've been using a lot recently, and I wanted to show you how trading options work on it. Now, Public is not paying me to make this video, even though maybe they should. So if you're watching Public, so get out your phone and let's follow along. Now, the first thing that you're going to want to do is pull up a stock that you want to trade options in, right? So in this case, we're going to go with Apple. Now, I like Apple just because it has a lot of volume, a lot of liquidity, and that is going to make it much easier to enter and exit trades. But nonetheless, let's pull up Apple. Now, the interface is really nice over here. I like it. Let's go through it just a little bit so you can understand what you're looking at before we jump into the option chain. Now, at the top, you can see that obviously it has the price, but also you can switch the graph to market cap. So you can see the market cap go up over time. And you also have the PE ratio, which is the price to earnings ratio. And you have a graph for that, which is pretty nice. Okay, now the price chart for Apple itself, right now I have it on 1 day, but I can switch it to 1 week, 1 month, all the way up to 5 years time. And then also here on the little button right next to 5 years, I can click on it and I could get candlesticks and all that good stuff. So if you're into all of those little trading patterns, you could have that on here. And I'm sure they have much more on the actual desktop app, even though I haven't played around with it too much. But for now, we're just using the line graph. So just we can see over time, Apple goes up. This is good, right? That's what we learned, right? If stock goes up, this is good. Buy call options, make money. Yay. If only it were that simple. All right, back to 1 day so we could take a look at what we are working with now. All right, now your position. Now, if you have equity, as in buying stocks on this, you'll see it over here. If you have options, you'll see it under the options tab. And they also have bonds, which is very, very interesting. And I'll show you. If I scroll down just a little bit, it has all the info about the company, right? So market cap, revenue, all of this is included with the app. And going down, you can see that their earnings per share, when they release quarterly earnings, it's going to show up over here. And down, if I keep scrolling, you have the options chain. But I want to show you this just for a second, because I think this is really interesting. You actually could buy corporate bonds on Apple, which is something that a lot of apps, particularly ones that I've used in the past, did not offer. At least didn't make it easy to see. So now I can see view all bonds over here, and I can see, oh, look, Apple is paying, 5.58% for this bond. And I can scroll down and I can see a bunch of bonds. All right, let's go back up to the top and go to trade on the bottom. And a whole bunch of options are going to pop up. No pun intended. Pun intended. I always say that, but pun is intended when I do that joke over and over again. Trade options at the top. So I'm going to go trade options and the option chain will pop up. All right, I have started a free business newsletter and I'd like you to sign up. So today's video is sponsored by me and my newsletter. Now look, over the past 20 years, I've come up with many different business ideas, hundreds written down in old notebooks. But let's be honest, there's not enough time in the day for me to actually do all of them. This is where you come in. Every week, you are going to receive history's best kept business and investing secrets, including 3 actionable ideas to start your own business or grow an existing one. We give you the ideas and you make the money. So basically the structure that I wanted to go with is I'm inspired all the time by things that I read or see online, and I take those stories as inspiration and create businesses on top of that. So within each newsletter, you are going to get the story that I was inspired by, as well as 3 interesting creative ideas that I came up with relating to that story. So whether you want to start your own business or have an existing one and want to grow it, these are all actionable ideas that you can take and make some money with. So it would mean a lot to me if you did sign up with the first link in the description. It's free, it always will be, and I hope you're gonna like it. So at the top, you are going to see expiration dates, right? So if I scroll all the way out, I can go all the way to a leap contract of December 17th, 2027. Or I could go for this week's contract, all right? Obviously, the closer that your expiration date is to the current date, the more risky your trade is going to be because there's less time for that trade to happen. And the further out that you go, the more time that it's going to take for your trade to occur. So there's more chances that the trade will go in your favor. Okay, now here's a very interesting thing that they included here. So right to the left of all the expiration dates, I go strategies, all right? And now they have all the strategies that you can choose from. So if we scroll down, you see long call, long put. This is just basically means buying a call and buying a put. When you buy A call, you are long the call, right? And when you buy a put, you are long the put. It's just another name for it, right? Covered call, when you own stock and want to sell covered calls on it, or if you own the cash, you could go cash secured put. And then down to the more complicated fancy strategies that I don't really mess around with too much. But if you are not sure, you can actually click on these buttons over here, all right? So if I click on the green button, that means that I think Apple will go up. As you can see, it says right there, I think Apple will go up. Pretty basic way to think about it. Now, if I click on the down arrow, here are the strategies that I would use if I think Apple will go down. Long put debit spread. All right, now if I think Apple will go up or down, all right, then I can go long straddle, long strangle. All right, these are different strategies that combine the 4 basic option trades. And if I think Apple will stay the same, then I could use long calendar spreads or long put calendar spreads. All right, you don't have to know all of this. Just unclick all of that, and then you can choose one of these strategies over here. I suggest sticking with the basics as long as you know the ins and outs of each strategy, then you should apply it to your investing. If you don't know and you haven't studied all of these, don't just jump right into doing them. All right. Okay. Back to the option chain. Whoopsie. So trade options. All right, now the option chain is going to pop up. Now, like I said, you have the expiration dates on top. Now, right under the expiration dates, you have the different types of trades. So right now you can see I have buy and call highlighted. Now, I know on the desktop version, they actually have colors up. I don't know why they don't have it on the mobile version, but you can see buy, call. But if I switch the call to put, now I'm buying a put. All right. Now let's go back to call. Now, if I want to switch to selling options, because you can sell options as well, and there's 2 ways to sell options. You can sell a call or sell a put, and this is what this indicates. If I go sell, now I'm at sell call. And then if I click the call button, you see it toggles back to put, and then I can sell a put. All right, so those are the 4 basic trades, and everything really revolves around these 4 basic trades. All right, so the first thing you want to look at is the current stock price, and it's going to show in the middle over here. So that green bar that separates the screen in two, that is the current stock price. All right, so current price $201.33. Now let's go to the left side of the screen. The left side will show you all the strike prices. Now the strike price is basically the agreed upon price between the buyer and the seller in the contract. So you can see all the strike prices here on the left. Now on the right hand side, you have the contract price, which is the premium price. All right. So all option contracts have these 3 characteristics: the expiration date, which is on top, and the strike price, which is on the left, and the premium price, which is on the right hand side. Now let's take a look at the $200 call. You can see that the option contract costs $2.34 if we were to buy this contract, right? $2.35 now because it just changed. Oh, 36, 238, 239. We missed out on gains. Good job. So basically what this means is you're not paying $2.38 for it. You're actually paying it times 100 because one option contract controls 100 shares of the company, right? So this, in fact, is $234, all right? So if you were to buy that contract, it's going to cost you $234. If you were to sell that contract, you are collecting a premium of $234, all right? Now notice you can scroll up and you can scroll down on this option chain, right? So what is the difference? Well, as you can see, the stock price is in the middle. Now, if I'm at buying calls, right? What does this mean? We want the stock to go up, remember. And the way that we succeed or win this trade is that we want the stock price to reach the strike price and then stay above it by the time the expiration date comes, okay? So anything that is under $201.30, this would be considered in the money. Now, why is that? Because the stock price is above the strike price, okay? So anything that we scroll below, we go down, these are all in the money options. All right, this is called in the money. Now, if we go on top of this and scroll upwards, any strike price that is above the current stock price, these are out of the money options because the stock hasn't reached there yet. Again, this is we're talking about buying calls. It hasn't reached there yet, and this is our goal. We want the stock to go up. So we want the stock to go from 201 of where it currently is, and let's say we have a call option. We bought a call option of 205. Well, we want it to reach 205 plus the premium. We're going to talk about that in a second. But you want it to reach that price and exceed it for you to start making money off this trade. So that means that everything that is above, so if I'm scrolling up, 202.50, 205, 207, 210, 212, these are all out of the money options. Now, it is riskier to buy out of the money options than it is in the money options. Now, the simple explanation for that is that all in in the money options have intrinsic value. So by expiration, if your option expires in the money, which means that your share price is above the strike price of what you purchased the option contract on, it will have intrinsic value. It will have value because essentially you would have the rights to buy shares of the company at less money at the strike price and sell it for more, which is the current stock price, and make a profit in between, right? And the out of the money call options won't have any value at expiration because there would be no value at buying stock at a higher price than it's trading at openly on the market. Now, here's something very interesting. Not only does the stock have to reach the strike price if you're buying a call option, but it also has to exceed it. And by how much? Well, here, take a look at the break even on the $205 call. Break-even price is $205.32. Now, why is there an extra 32? Well, if you take a look at the premium over here, how much does this option contract cost? It costs 32 cents. So you want to take the strike price, add the premium price, and that is your break even on this trade. Because even if Apple reaches $205 and you have a $205 strike price, well then yes, you could buy it at 205 and sell it at 205, but you already paid a premium of 32 cents, so that has to be factored in. So that's why the break even price is the strike price plus the premium paid. So let's go ahead and click on the $200 call, and you're going to see all the information pop up. Now let's go through this really quickly one by one so we could understand what we're looking at before we make this trade. Now first, you're going to see the bid and ask. Now this is simply the buyer and the seller trying to buy contracts and sell contracts. So if we take a look over here, you have the bid, and that is what people are bidding on this contract, right? I like to think of it in sort of eBay terms. I'm bidding on an item. I want to buy that item, so I'm bidding how much I want to pay for it, right? So in this case, the bid price is $2.19, and the ask price is the seller of how much they are willing to sell for at a minimum $2.21. Now, this is the bid-ask spread. So it's the spread between the bid and the ask. And you see it's constantly fluctuating up and down, right? So right now, if we were to purchase this, we would probably get some sort of middle point, right, between the bid and the ask. And that's conveniently marked here as the mark. Another no pun intended joke. So you have the mark price of probably what you will get filled at, okay? Previous close, last trade, volume. Now, volume is the amount of contracts that were traded today, and that resets every day, right? So today, 12,922 contracts of this specific strike price and expiration dates were traded. So that's a lot of volume, all right? Now, the interest, now that's interesting. I'm full of them today. Now, the interest is how many open contracts there are, right? So if I buy a contract that's an open contract, I haven't closed it yet. If I sell a contract and I didn't buy it back, that's again an open contract. And that number is how many open contracts there are. So 17,265 open contracts. That's a lot of contracts. Let's go to IV, all right? IV is very, very important because this shows the implied volatility of the underlying stock. Now, the underlying stock is Apple. So it doesn't show the implied volatility of the option contract, but rather the underlying asset, which is Apple. And in this case, 26.81%. So what does an implied volatility of 26% mean? Well, this means that Apple, the stock, will trade up or down in the range of 20%. So I'll give you a simple example. If the stock was $100, let's say, then if you have an IV of 20%, it will trade between 120, so 20% up, and 20% down. So it'll trade between 80 and 120 for the $100 stock, right? And so you could do the math. Oh, and again, this is for a 1-year period, all right? So 1 year, the market is saying that we think that the volatility of the stock will be in the range of 25%. So again, there's a range, 25% lower, 25% higher. Do that math, pick that range, and that is what it's likely to trade in between for the next year. Now, if we go a little bit further down, you're going to see the Greeks. Now, this is a pain point for every option trader. Taking a look at these Greeks, understanding what they mean. You have delta, gamma, theta, vega, rho. You're like, I don't know what's going on. I quit. You exit out of the app, and then you go cry in the corner somewhere. Not that I've done that before. I have, possibly. What? So delta and theta, in my opinion, are what you should concentrate on, and I'll give you a quick rundown of those. So delta is the amount of change your option contract is going to incur with a $1 stock movement, okay? So really quickly, that means if you have a $100 stock and it shoots up to 101, well, what does that mean for your option contract? Well, that means that your option contract will go up in the amount of delta. So right now, delta is 0.63, so 63 cents. So every dollar movement for the stock, that will increase your option contract by 63 cents. Now, theta is another thing that you should concentrate on because theta tells you how much value your contract will lose every day that goes by. All right. So naturally, options will lose value from the day you open them until the day of expiration. And how much is it going to lose? Well, that's the theta amount. So you can see theta is negative 0.37, so 37 cents. And that means that your contract, which costs $2.17, is going to lose 36 cents every day. Now, the reason that this is so high compared to the price of the contract is because we have an expiration date of June 27th, so that is this week. Now, if you were to go further out, so let's just go to a further out expiration date. Let's go to October, for example, and we go to the $200 calls, the same one. So you can see that the theta is just negative 0.06, so only 6 cents are going to be taken off the contract every day if nothing changes. And this is a very big point over here. So if the stock goes up, if the stock goes down, then the option contract's price can fluctuate as well. If nothing happens, so if the stock just stays flat, this is the amount that it will go down. So the stock doesn't have to move, but as the days go by, it will lose value because of this great thing called theta. So theta eats away at your option contract every day. All right, back to the June 27th $200 call. All right, now I'm going to click right here on the break even. Right above it, there's that little arrow, and it's going to show me the break even price. Now, like I said, strike price plus the premium is your break even. So as you can see here, you have a $200 call, right? So at $200, you are still losing the premium of $219, how much you're paying for the contract. Now, if I move up to where the red meets the green, I'm going to see my break-even price. Now, my break-even price in this case is $202.20. So again, it is the strike price plus the premium paid. And everything above it is profit, all right? So it has to reach at least 202.25 in this case. Now, this is just because the option contract is constantly moving right now because the market is open. But I'm going to get profit all the way up, and it is unlimited profit if you buy call options. But your loss is capped to $228, the amount that you're paying in premium to buy this option contract. Okay, good. Let's buy to open. Now you're going to see at the top left corner here 4 types of trades, right? You could do a market order, limit order, stop order, or stop limit order. Now, market order means that you're going to buy at the current market price, all right? So you're not going to worry about specific price. You are just going to worry about executing that trade. And this is used when you don't care about the specific price of your option contract, a few cents here or there. You just want to buy it right away. So this is the fastest method. Now, limit order, buy at the limit price or lower. So I don't want to pay more than a certain amount for this option contract. So I'm going to put a limit order, and this is going to be the highest amount that I'm going to pay for this option contract or lower. If the market could find me a lower price, it's going to do that. Right now for stop order. Now imagine that you bought an option contract and you're holding it, right? So the price is going up and down and you bought it at a certain amount, but there's chances that it will go down. Well, you don't want it to go down too much. You want to sort of cap your losses. So you could put a stop order in, and that's going to buy at the market price if the price drops to the stop price. So if the price drops down, then it's going to trigger a market order and sell your contract, right? So this is to prevent losses. Now, a stop limit order. Now, this one is interesting, but a little bit confusing. So a stop limit order adds more control than a regular stop order, right? So it has 2 things, as you can see. It has, if I click it open, you'll see 2 things. It has a stop price and it has a limit price, right? So a stop price triggers the order, and a limit price will set the maximum or minimum that you're willing to accept for this trade, right? So as an example, if you have an option that's $3 to make things simple and you place a stop limit order, then you could put a stop at $2.50 and a limit order at $2.40, right? So if it drops to $2.50, it's going to trigger a limit order, and if it drops, then it will sell no less than $2.40. So again, it protects you from selling too low in fast moving markets, all right? But for now, we are going to do a market order just to keep things simple. We're going to go 1 contract. So again, 1 contract is the premium times 100. So I'm paying $215 to buy this option contract. Let's review the order. So market price $215, 1 contract. This is your total of the premium that you're paying. Submit order. And we should have a contract on our hands. This is very exciting. All right, order complete. And let's hit done. Now, if we go back, we can see if we click on options under your position, then you have the current value of your option contract, which is $213. Total cost was $213.99. So we already lost 99 cents. But we're going to keep this contract open for a little bit and see what happens.
A few moments later.
Well, this is very exciting. We have made a profit of $1.01. I think it's time to close out this option contract. So in all seriousness, I'm just showing you how to open and close a contract. We're not trying to make any serious gains here, although it would have been cool if we did. So now we have the option contract in the profit and we want to close it out, right? Oh, hold on, hold on, hold on. We've just doubled our profit. We now have a total profit of $2.01. All right, breaking news. We've just quadrupled our profit from $1 to $4. So we're going to go ahead and exit this position so we can lock in those $4 gains. I'm going to click right here to open this contract. Oh wait, never mind, profit of $8. We're just racking it in over here. Never mind, $6. All right, let's close this out. Trade on the bottom right, and I'm going to sell. All right, we bought it. Now we have to sell it to close our contract. So we have one contract. We're going to put one, total order, review, and submit order. Bingo bango, we did it. We opened up an option contract, we bought some calls, we sold it at a profit. Mission accomplished. Bam. All right, so hopefully not only did we learn a little bit about how to trade options on public, but also we started learning how to put these pieces together, what everything is on the actual option chain, so that when we go to make a trade, we know beforehand everything that we need to know so that we're not confused in the moment of having to execute something. So thank you all so much for watching. And if you want to dive deeper into the world of options, I have a whole bunch of videos that you can check out right now. Make sure to sign up down below to my free newsletter. I would really appreciate it. And we will see you on the next video.